Your market news now. The dollar rebounded off a 15-month low and global stock markets rose as upbeat earnings on Wall Street and retail sales pointed to a resilient U.S. economy. This sealed expectations that the Federal Reserve will hike interest rate hikes next week. Meanwhile, the rand dipped after data showed local inflation fell more than expected in June, but moves were slight as traders hold off from big bets before tomorrow's interest rate announcement. The rand traded around 17.94, which is 0.4% weaker than its previous close. It has been marginally firmer before the inflation figures were released. To give us more perspective on the markets, we are joined by Chantal Marks from FNB Wealth and Investment. Chantal, thank you so much for your time. Given this upbeat mood in terms of U.S. earnings as well as the retail figures coming out yesterday, what do you make of market sentiment both globally and locally?
Yes, so definitely a little bit more positive, and I think that has been complemented by a very soft CPI print in the UK. So the expectation now that UK inflation also coming a little bit more under control and monetary policy could become less tight over there, as well as the rest of the world. So it just seems as if everything is pointing towards things getting better rather than getting worse, perhaps a recession being avoided in the US, and risk markets are reacting to that positively.
So earlier we had Pick n Pay releasing their trading update, foreseeing a plunge in interim earnings, as well as mentioning 300 million rand being spent on diesel costs. And this is from the months March to June. Given the figures that have been released from this trading update, what kind of picture does it paint in terms of how tough it is out there for retailers like Pick n Pay?
So I think it's tough for retailers generally at the moment. I mean, you have a consumer that's under a whole lot of pressure. Inflation is high, interest rates are increasing, and people are really having to be quite careful around how they allocate their budgets. I do think, though, that not all the food retailers will be performing as weakly, for lack of a better word, as Pick n Pay. There's a probability that, or a substantial probability that Pick n Pay has also lost some market share, particularly in its grocery business. So if you look at the sales growth rate of just under 5%, a lot of that was actually driven by clothing and liquor, whereas their core grocery business shrank, or very close to shrank during that period from a sales perspective. And if you look at retail sales numbers, that wasn't the case for that category overall. So I think a lot of the issues being faced by Pick n Pay are within the Pick n Pay stable themselves, obviously amplified by a very pressurized external environment. What Pick n Pay is also grappling with is restructuring. They also moved into a new distribution center recently, so they have to duplicate some supply chain costs. And then load shedding seems to be impacting them in a pretty big way as well. Although that 300 million is implying a lower run rate than the last few months of their last financial year. Probably over December, January and February, it does seem as if things have softened a little bit.
The other company that caught my attention was ArcelorMittal yesterday afternoon, releasing their trading update and highlighting that load shedding and stubborn debt costs basically will be impacting the company. That share price fell 40%. It's recovered today, up 19.5%. And I suppose this is a big turnaround for a company that had indicated back in February that they saw a positive outlook in terms of trading performance.
Yes, so I mean that update was an absolute mess yesterday, because you had a company where they had an outlook of things actually getting better, and they only warned the market 6 months later that things actually weren't getting better. In the meantime, you also had a new CFO start at the beginning of this month and resign about 2 weeks into his tenure. So a lot of red flags, I guess, around ArcelorMittal and their disclosure at the moment. At least they did come out with this profit warning. I think we're not entirely surprised that things didn't go as they expected, because we know that there were some very specific challenges over the last 6 months of the year, or the first 6 months of the year specifically, as it relates to load shedding, rail performance, general weakness in some of the kind of steel making or steel utilizing industries. And I think that ArcelorMittal in particular are extremely vulnerable to load shedding, being a high energy user. And what tends to happen at these smelters as well is that if you are not running continuously and you have to keep on starting and stopping and starting and stopping, you don't have any sort of operational momentum. So your capacity utilization and your efficiency within your operations deteriorate substantially. I think that they should have warned the market a little bit earlier. Probably the 40% was a little bit overdone, and that is why you are seeing the recovery today.
So earlier we had CPI data come out, but at the same time we still have these ongoing rand risks, as well as inflation expectations still outside of the bank's preferred parameter. If you had to advocate in tomorrow's meeting with the SAB, if you could be in that room, what would you advocate for, a pause or a hike?
Well, I mean, as a consumer, I would love for them to pause, right? But I think that you have to think about whether or not inflation is going to continue coming down into that target range, or whether or not you're going to believe the inflation expectations barometer, which says that inflation could actually pick up again. I think we're erring on the side of caution, saying that we think that the SARB will probably hike rates by 25 bips. But I think that an equally strong case can be made for them to just pause and wait and see what impact their cumulative hikes until now, as well as the 50 basis point hike at the last meeting, has actually had on inflation. Give it a few months, see what happens. But I mean, that's the consumer in me speaking. I think they'll probably be more prudent around it.
Before I let you go, just quickly, one company that you are paying attention to when it comes to US earnings.
So at the moment, we are looking forward to the tech companies starting to release results. We had the banking stocks release numbers that were better than expected. And I think today, with the release of Netflix numbers and Tesla's numbers, I think it's going to give us a good insight into how the kind of new technologies are going to perform. Tesla within that electric vehicle space, and a few other areas. And then Netflix, not exactly a bellwether for tech, but it could give us a sense of where we're heading in terms of profitability in that space.